Hey, it's
Got
Andrew
it.
here. Andrew here from Mortgage HQ. I've got Darcy with me. He's in the finance space himself, pretty popular on the podcasting side of things, and we've joined together in a marketing mastermind with a bunch of other finance guys. I've been learning from somebody who's been doing it a lot longer than we have. You've been in the game 20 plus years, right?
Almost. Actually, I had to count before. It's actually only 19 years. Sorry.
Yeah.
Yeah.
Won't
Close
be
though.
long. Won't be long.
Won't be long.
I got more grades than you, so maybe you're doing something right.
It's called Just for Men. I recommend it, man. It's
Yeah,
great.
yeah. So tell us about your business and what you've been
Yeah.
doing with the podcast.
Okay. Yeah, great. So I've been, like you say, I've been in the business for about 19 years, started off as a mortgage advisor and slowly kind of grew the business, insurance advice, Kiwisaver, now into financial planning. And I guess I've kind of grown the business around my clients, which usually involve helping them out with their first home, helping them out with their first investment property, then their upgrade move, and then somewhere along the line, developing an insurance plan for them. And then probably more recently, especially since I started doing the podcast, it's much more around financial planning and making sure that we're not just using tools, but we're
Mm.
actually building something. And that's kind of what I'm passionate about, is building stuff with people, building wealth with people, and looking at all of the tools, both the tools that we're familiar with and the tools that we might not be familiar with.
Mm.
And then just figuring out a strategy so that people aren't going through life reacting to the life stages that they're about to see, but they actually go through life with some structure and some intent. That's kind of what I'm really passionate about.
Yeah, the life stages seem to be the stereotypes hold true a lot of the time, and people don't realize what stage they're in, and you can kind of give them insight into what they're about to go through. And
Yeah.
you marry that up with their life stages with what's happening in the market, which it's pretty interesting times. The last two years, there's been big gains in pretty much everything, and it's been relatively easy to make money if you're in the game. Well, how do you see the next 3 to 6 months playing out?
Yeah.
The property market, share market. What do you
The
think?
whole shebang. Yeah, the whole shebang. And I think what you said before is really interesting, Andrew, because the the micro, like what's happening in our lives as we go through those life cycle stages, and what's happening in the wide world, the macro, often people kind of gravitate towards one versus the other. They
Mm.
think about, what do we need to do next, without taking any of the outside world into consideration. Or they
Mm.
often make decisions around, what should we actually buy an investment property now because I heard this is happening, and they think too much about the outside world. But yeah, I think what I like to do is try and find that mix with people. What's an appropriate amount of weight to put on external considerations, which is what you're asking me now. And
Mm.
I think the first thing that comes to mind is that we've seen a lot of alignment in the last 2 years, obviously with an appropriate health response and all the rest of it. But we've also seen an alignment between central bank policies around the world, which brings a lot of the economies in line with everything at the same time. New Zealand seems to be kind of going first in a way, which is quite interesting, because I think, I don't know if this rumor is true, but New Zealand seems to be a test bed often. That's the rumor anyway. It seems to be a test bed often for new things, and going first in the area of tightening money printing, like
Mm.
slowing down the money printer machine and increasing interest rates. That's not done in the US yet. They're just barely talking about it now, but we've done that now already. So I think that's going to be interesting. And in the next 6 months in particular, I think it'll be fascinating to see the impact of the interest rate rises, right?
Mm.
Because we've seen almost a 2% increase. So let's say there's 2/3 of all Kiwi borrowers in the next 6 to 9 months, especially, that will be coming off their relatively cheap fixed interest rates. And they might be going up as much as 2%,
Yeah.
especially if they're going from a 1 year to a 2 year, right? And that works out to be about $1,650 per month
Yeah.
on a $1 million mortgage, which is about 17% more of an expense on a typical household of 150 grand. So that alone, I think, is sufficient to put a lot of households over the edge and create a lot of financial uncertainty in people's lives. So that's the number one thing that I see is impact with that. The next thing that I can think of is the CCCFA, the Credit Contracts and Consumer Finance Act. I'm pretty sure with your audience, you would have probably spoken about this before, but effectively what it means is that there's going to be less new credit created in the economy, and that will hit the property market first, but naturally flow through to the broader economy, because a lot of new credit creation comes via the property sector. That will have a significant impact. So interest rates, less access to credit, higher taxes, right? So we all love taxes.
It's coming.
It's coming, man. It's being as well, right? So if you're earning a certain amount, beyond that, you're paying more in tax. If you're a property investor, you're paying more in tax. And there's a lot of other hidden taxes, right? But there is more tax that we have to pay. Less money being circulated, or less new money coming into existence, and more redistribution of money that's already in the system. So that has an impact. And then I think the other last thing really is the psychological effects that might come when markets change. And that's when people start to read a lot more about the property market actually correcting, rather than just these fringe people speculating it will happen. Yeah. If it actually does happen, especially if equity markets correct a little bit as well, the psychological effect will slow down the velocity of money. Money won't move so much around in the system. That self-fulfilling prophecy. And the last thing, though, just to point out, and I'll try to do this as much as I can, because sometimes I get quite negative with what I say, this isn't all bad, right? Like, I think that's potentially, it's great news if you can see the positive in this and you can recognize some opportunities.
Yeah.
So that's what I think is happening in the next little while.
There's opportunities in every market. And if you're open to the idea that there is a good deal out there, and sometimes you got to make good deals. You got to spot them for their potential after you've done some work. It's not just in front of you advertised the perfect deal. You've got to have the knowledge, and you've got to have done the research, so that when something that can make you $1 million hits your desk, that you can see it, you know. And most people don't want to do the work to get themselves to the level of understanding that is required to be able to turn an opportunity into $1 million. So that's a good point. And if nothing else, when the market is going through a lot of turmoil, it's a really good time to double down on your researching and your learning. And there's no doubt that eventually the share markets will have some sustained long periods of downturn, because they've had such strong upticks for so long. And the same with the property market. There will be downs, but that's part of it. If it drops 5 or 10%, it's not the end of the world if you're in it for the long game. And it's especially not a big deal if you can manage the repayments and add value. And people are always going to need somewhere to live.
Yeah, that's right.
So what I've seen that you've got links in your podcast about Sharesies, about Hatch. Now, what investment platforms or news outlets are you reading and working with a lot that you find exciting?
Yeah. So in terms of the ways to invest and the portals or the doorways, I'm a big fan of what the likes of Sharesies and Hatch have done specifically, because they have done nothing new in my mind. Like, it's not like it's rocket science that they've created something amazing, but they've created a really, really easy user experience to help onboard newer investors in particular. And it's really important, because that's one of the things that have put people off for so long, is that you have to have a lot of money to invest, and you have to have a lot of smarts, and you have to deal with other people. Here now, you just open up your phone and off you go. Yeah. So big fan of that, right? Now, I'm not personally super excited. It doesn't get me out in the morning around investing in individual companies. I do a little bit of it. I have a portfolio of individual shares, and I think it's important that every investor has that as one of their minor portions, what I call a satellite component or a concentrated component. Yeah. But it's not something that I find super exciting. What I do find really exciting in terms of the new space is just the plethora of decentralized options. So this is more peer-to-peer blockchain-based systems that you can start to use. So that's like having a cryptocurrency wallet, signing up to Celsius and earning money on your crypto assets in the form of crypto. You can actually get interest off that. Yield farming, staking, amazing stuff happening in the decentralized space. So what I've tried to been what I've been trying to get my head around lately is more how to use these platforms, what the risks are, and how much should I personally allocate towards those types of platforms so that I'm at least in that space and potentially benefiting from what could happen there without literally betting the whole house on it. And then in terms of content, I try to be really diverse, I almost look at the content that I consume in terms of educational content, blogs, YouTube channels, podcasts. I try to mirror the style of content that I'm listening to with the investment style that I have. So I personally follow a core satellite type of structure. Maybe we can talk about that later on, but very diversified mainstream for the bulk of what I do, but then very concentrated specific niche for a few small satellites, a few small areas. And so I kind of set up my content regimen as something that kind of speaks to that. So I'm not getting out of balance and tempted to rebalance my portfolio in a way that's not appropriate. Does that make sense?
Yeah, 20% crypto, right?
Exactly, 100%, man, 100% to the moon.
There's now I've seen there's some Kiwisaver providers shifting some allocations into crypto, and I think they'll see more and more of that. People are going to want exposure to crypto, and if you don't offer it, you're going to miss out on some sector of the market, which is totally fine. I've seen some providers with crypto in their funds have made very big gains off the back of that. So it does drive good fees and good performance bonuses for those guys when it goes well. And when it doesn't, start a new fund, not a big deal.
That's right. That never happened. Yeah.
So what about people? Let's say they've got a bit of home equity, the homeowner. What do you feel about people investing some of their equity into non-property assets or investments?
Yeah, I feel good. I feel really good about that. And I think that, again, it's like you follow a typical first home buyer through their life. And some first home buyers will only ever own one property and focus like crazy on getting rid of that debt and maybe contribute 3% of their salary towards Kiwisaver. And that's their retirement. And maybe that'll be okay. But if you want more, you need to do more. Simple, right? So diversification is important because we don't really know what the important, what the things are going to be in the future that will certainly be successful. So taking money out of your mortgage or simply foregoing the option to repay your mortgage more aggressively is almost the same thing. It's the same thing. It's borrowing to invest. And so which way you do it is kind of irrelevant for this conversation, but the fact that you do it, I think is really important. And Kiwisaver is the first important thing that people do. And they need to consider the possibility that 3% is not enough. But whether that's done via Kiwisaver or a fund which is like Kiwisaver, but without those restrictions, that's a consideration. Whether it's exchange traded funds via Sharesies or Hatch, that's a possibility as well. But just like what you were saying before with a Kiwisaver provider who's allocated a small amount towards crypto, I think there should also be some thought and some intent around how you design your portfolio if you're getting outside of property, because you need to think about what portions you allocate to certain areas and what risks are present in those areas. But yeah, no, I think it is important for any investor, whether you just have a home and Kiwisaver or you have a home and a few properties, that you consider other investments and you start to view your debt reduction almost as a type of conservative investment in and of itself as well.
Yeah, I think maybe a helpful analogy for people that don't feel comfortable talking about money is the rugby team has 15 different kinds of players, and you don't want 10 Aaron Smiths in your team, even though Aaron Smith's best halfback in the world. Like, you only really need one, and he'll run the show as halfback, and then you need a number 10 and a number 12 and different types of investments up to a certain point that is going to create a strong rugby team. You don't need 30 guys on the team on the same. No, that won't work either. You need some space, and it's the same with investments. If you try and have too many, then it's probably cloud you. But if you don't have enough, then it becomes a bit messy. And no, I definitely have more of a spread of business investments, shares. I've stayed out of crypto, which people will gasp like, oh, how, I'm happy to miss the boat on crypto and come in a little bit later, so that I can be more researched on my other investments. And that's a purposeful decision. It's not from an ignorant position. So trends into 2022, I think you've kind of touched on that.
There's one more trend actually in 2022 though, if I may interrupt.
Go for it.
That I think probably warrants a mention. And it's kind of in the line of what you were just saying, Andrew. Instead of the rugby team analogy, I'll often use a pot of stew. And that's kind of the same sort of thing, right? but at the end of the day, it's just food, and all food goes off. And the issue that I have with using diversification is that it provides a lot of false hope. So now I was saying before, hey, I think diversification outside of property is really good, but there's actually a right way and a wrong way to go about it. So I'm going to tie two things that you said, the rugby player analogy and the, I can't remember what the hell you just said. You might have to cut that one out because I can't remember. Oh, the crypto thing. Yeah. So leveraging off of that rugby analogy and the crypto thing, most of us diversify, but we diversify into investments like maybe Kiwisaver, shares in businesses, startups, specific companies, managed funds, whatever it is. We diversify and we have bonds, fixed interest, whatever, right? But the issue is that they're all denominated in dollars. And this is a thing that just I cannot get. Either I'm fascinated by something that's super simple and I need to get over it, but I just cannot get why people don't understand this, that you're not actually really diversified properly until you get out of the denominator. You need to have something allocated, which is a value container outside of traditional mainstream investments. Even if you have a broad variety within that rugby team, you still will have people that don't like sports or will ban sports in the future. So you need to make sure that if there's a systemic failure, you've got an alternative store of value that you can lean on. Precious metals is what I'm a fan of, physical precious metals, but I know it's not that sexy these days. Crypto is easy, right? And that kind of makes sense. So I think one of the big trends that we're going to see in 2022 is this growing distrust in mainstream financial thinking and more openness to adopt alternative strategies, which will be easy to imagine in the crypto space. But I think even there might be a revival of sorts happening in the physical precious metal space. So that'll be interesting to see if that plays out next year as well.
One of the guys in the office, one of the advisors, he did quite well in crypto at the start. They made like 30, 40 grand off like not much to begin with. And he sold it all and now he's got silver buried in the backyard, which I find both of those sides of the story funny. And I'm glad, there's
more than one crazy person in this world, Andrew, and you know two of them now. So that's good.
If we get in a situation where anarchy rules, then I'll got to rely on brute strength, I guess. You can have some crypto and we'll be out on the streets.
Yeah, that's right. Silver bullets, getting ready for the zombie apocalypse. But that's kind of why I think like how we think about money, how we think about finance. Again, for me personally, I try to think the vast majority is mainstream. But when I do think about these fringe kind of alternative thoughts, I think about them really intensely. But it's not to say that that's who I am. It's just a place that I go to as a matter of diversifying my brain. And so you don't have to be a vegetarian to try the salad here, I guess is what I'm saying.
Oh, it's prudent to investigate things that get a lot of attention and momentum. And there's a lot of smart people on both sides, Totally. So, how can an average guy figure it out if you got guys with 150 IQ on both sides of the argument?
That's right. It's not about smarts.
You just hedge.
Right.
Yeah, just hedge your bets, right?
Totally.
So how do you think the lockdowns have affected your investment tactics and philosophies, personally, and the way that you're advising clients?
Yeah, that's good. Well, one of the biggest ways, and this is a fairly middle of the road mainstream way of thinking nowadays, but I've kind of always had this belief, maybe going back probably 19 years ago even, that the value that our dollars can hold will slowly decrease over time. In other words, our dollars will lose purchasing power and interest rates will go down at the same time. So because I had that belief, I was always very quick to personally want to get into mortgage debt to buy property.
Yeah.
And when I was dealing with clients, it was the same thing. Because to me, it's like the perfect trade, right? You
Yeah.
take something that's dropping in value and you trade it for something that's going up in value, something infinite for something finite. It's like everybody's going to take that trade every day.
Yeah.
So that kind of stuck with me. But when I was talking to clients, I had to be really careful with how I framed it, because going back like 10, 15 years ago, that was quite fringe to think like that.
Yeah.
And when the lockdown happened and it was clear that the regulators' first instinct was to drop interest rates, then it was further proof that COVID obviously accelerates everything. And that means it's confirmation, in my view, that we're still in a long-term downward trend of interest rates. So now I'm kind of more open with my clients because of what COVID showed us, that this isn't just a crazy, wacky theory. The dollars are dying. And if there's an opportunity to make that trade right now, people can position themselves for an amazing growth in their wealth if they just understand the macro dynamics a little bit here. So that's probably the biggest thing. I'm sure there's other things I've learned, but that's probably the biggest thing that I've learned because of the whole kind of lockdown thing.
Yeah. If you're not making capital allocation decisions, then you are making them without realizing, and it might be costing you a lot.
Good point.
Just choosing investment funds instead of doing term deposits is going to mean that your wealth erodes at a much slower rate and potentially grows, even if it's slow. It's one of the things I hate about some of the mortgage industry is that there's a lot of advisors out there pushing increasing repayments and paying the mortgage off faster, which creates a then what problem. You get mortgage free, and then what? You're going to put your money into unleveraged investment funds, or you're going to put it in Kiwisaver. If the then what situation says, oh, we'll buy another property. Now, our argument is just, why not just do it a little bit sooner? Why pay the mortgage off now? Especially signing up for the commitment of the repayment, when you can just do the extra repayments without the commitment, you get your money back.
Yeah, you're touching on something so interesting that I find really interesting. These younger first home buyers, they drink the Kool-Aid that not their parents, but their grandparents give them, which is debt is bad. All debt is bad. Therefore, get rid of it first before you invest. And I think that's done the younger generations an incredible disservice, because when you're young, that's when it's risk on. Yeah. When you're in your like mid 50s onward, you're in peak income years. Hopefully your kids are starting to become financially independent. You don't need to worry about them. It's never going to be as easy or as it is then to repay your mortgage. Therefore, don't pay the opportunity cost today. Invest and repay the debt at the same time, or prioritize investment if nothing else. Good point.
Yeah, we kind of joke in the office that paying off mortgage debt is for losers. That if you're paying off your debt, then you've got no creative outlet of how to make more money. And no, I admire someone that wants to get mortgage free. That's a good goal to have. What I think people get delusional about is how quickly that's going to happen, and that using a 30-year time frame to pay off your mortgage is actually fine when you're building up more assets. If you're buying 3, 4, 5 investment properties over 30 years and you still haven't paid off your own mortgage, it's not a big deal, because your cash flow will be so strong in that in 30 years time. Now, it is scary, and it's unrealistic for everyone to be able to do that, because people go through divorce, they go through income changes, they go through life challenges. So you just got to be pragmatic about that at the same time. And if investment property is not the right thing, then simply investing in other things like crypto, like shares, like investment funds is a really good starting point.
Yeah, that's right. That's right. We don't know what the future holds, right? But I think it's just having this outside awareness of where we are relative to our environment is really important, because what you were just saying there, a lot of people don't see that because they're in it and they're reacting to information as it comes to them rather than proactively going out and gaining an outside perspective. So I guess the moral of the story here, right, is to get some advice, ideally not from Uncle Fred, right? Get some advice around what you can do to use these tools for your advantage and be on the right side of what's coming rather than be a victim of it, right?
Yeah. And if you're got 10 grand and you want to do some sharesies or hatch, that's all good. But if you're talking about 100 grand or more, then getting advice probably makes more sense. And the analogy I use is if I pop the hood on my car and try to take the engine out and put it back in, to a mechanic, they'll just laugh in my face. Like I just know absolutely nothing about it. I could take the nuts and bolts out and dismantle the thing. There's no way I could put it back together. And it's the same with finance, is you can get so far enough that you're going to create a lot of drama for you later when you realize you can't put it back together and you've broken something.
Yeah, that's a good point.
So it's finance is just easy enough that people feel like they could do it themselves, but that's that Dunning-Kruger effect, right? They they don't realize what they don't know until it's too late.
That's right. Yeah.
So if people are going to jump on your podcast, where do you suggest that they start? What's been the most popular thing this year?
Ooh, yeah, that's a really good question. Actually, the most popular episode I did was actually recorded probably exactly 12 months ago with an American author by the name of Jim Rickards. Jim Rickards, have you heard of this guy?
Yeah, Ruins or something, one of his books.
Yeah, what is it? Road to Ruins? No, I can't remember.
Road to Ruins, one of them. He's a real gold bug, and he's been on the Investors podcast. Yeah.
Same message every time you talk to him, but he changes it every time he writes a new book. But it's fantastic, the message that he's got out there at the moment, I think, anyway. A little bit controversial. I remember catching up with him again this time last year, and I was editing the episode, and I had to actually take something out, and this is like the inside scoop that no one's heard yet, but I had to take out the fact that he has quite a strong opinion on quite a few things. And one of the opinions that he has, which was absolutely not mainstream back then, was the fact that coronavirus came out of a lab. It was a lab leak. So he was in that camp, right? And that was not popular back then because the man with the big orange hair was saying that. So I remember having to take that out because I thought, oh no, this is really going to ruffle too many feathers and I don't want to offend anybody here. But now in hindsight, I'm thinking I probably should have left that in because it seems increasingly like that's the truth now. But yeah, so that's probably the most popular one, and it was entitled Investing Post-Pandemic. So it was a really, really good episode. But anything that I talk about in relation to property and crypto are the two #1 downloaded topics, partly because it's an interest of mine. It's probably the niches that I kind of naturally go towards. But I think in the season that we've just been in, maybe that's what people have been most interested in. But I do cover a lot of stuff that I know, not necessarily on purpose, but I know people will not enjoy it. But I firmly believe it's important that people try to get an understanding of it, because the world is changing, and unless we don't update our operating system, we're going to be potentially left behind.
Yeah. I was just laughing with you before we started about the warning on your podcast. This content may disturb those with an inability to distinguish the difference between opinion and fact, and it's really just making you think for yourself. You're trying to get thoughts and opinions that people wouldn't naturally be exposed to. So it creates,
you can figure it out on your own, right? Like everybody out there, like everyday investors actually have the answers. It's just that they've been indoctrinated with a bunch of rubbish that needs to be gone, basically, or called out for what it is. Because people are smart. They can actually make decisions on their own, but they need to be challenged intellectually. They need to be challenged about what they hold as true. Otherwise, they're just going to be suckered into somebody else's sales funnel, and they're not actually going to be making any progress for themselves.
Yeah. If you want to have a laugh, you go read the Tony Alexander newsletter for the week, and then you go and chat to some finance guys or some wannabe finance people about, and you'll hear a lot of Tony's views come out, right? It's
funny how that works, eh?
Yeah. And it's
I've got a lot of respect for the guy. That guy, he's really good. Like his newsletter is fully recommend subscribing to it, by the way. But he just said something. I pulled this out regarding cryptocurrency. This is what Tony Alexander says. These assets have no intrinsic value and are largely favored by young investors pity about the environmental degradation. So that's Tony's view, right? Now,
Yeah.
if mainstream financial commentators are just taking that and not thinking for themselves,
Yeah.
well, the price you pay for Bitcoin is the price you deserve, is what I say.
Yeah. And contrarian views are usually the ones that make the most money. You just have to figure out which contrarian idea to follow. The herd is right a lot of the time, but when the herd's wrong, that's when you can make a lot of money if you're doing it the right way. That black swan mentality. If you just follow along the herd, it's very hard to get rich.
You got that. That's right.
I appreciate your time, Darcy, and we'll try and link some of the key stuff that you think is important in the show notes. And look forward to our next marketing mastermind catch up, man.
Awesome. Thanks very much, Andrew. Appreciate it.